There's so many advantages when it comes to taxes in being a rental property owner. So I took some time to sit down with my CPA and somebody I go to with all my questions about our rental properties to talk a little bit about tax strategies and some of the tax advantages, some of the deductions and things like that that you can expect as a rental property owner. So let's get to my conversation with Mark Myers, a CPA, and hopefully this will share some more knowledge about what you can do and what you could think about when it comes to your rental property and your taxes. I wanted to just welcome everyone tonight to we are now in tax season, so we kind of thought that this was a good topic for now, as everyone is preparing and sort of, hopefully not doing their taxes too late like we sometimes tend to do. And as a real estate investor and as clients, we want to continue to provide some education as we learn new things, and we have professionals who can teach us all a lot more of what we don't know, and how we can better maximize the benefits of owning rental property. So I wanted to start by introducing Mark. Mark Myers is he's our accountant. He's a CPA. He is our, really, Craig and my, from our business, from our personal taxes, from our investment properties. He's our go-to person for all questions about all of it. And there's something always changing. So Mark is a wealth of knowledge. And so we thought let's bring him on and sort of go through some of the benefits of owning real estate, and then be able to answer your questions. So I'm going to let Mark introduce himself and some of his background, and then we'll go from there. So thanks for being here, Mark.
You're welcome. Good evening, everyone. Hopefully we're going to have an informative hour here for you. A little bit about myself. I've been in the practice of public accounting for over 35 years. I spent 20 years as a partner with a local Northern Virginia firm. And for the last 5 or 6 years, I've been practicing as a sole practitioner. I decided I want a little lifestyle change, and I thought practicing on my own was going to offer me more what I was looking for. As Sue alluded to, been working with Craig and Sue for a number of years. And I like I say, I run my practice from my house, and that's a little bit about me. And again, I've had my CPA license for over 35 years. So
yeah, so he's gotten to know our business, and I'm sure he works with many other investors as well. Okay, so what we thought we would do is try to give just some general information. So here's kind of an overview of what we're going to talk about tonight. So we're going to talk a little bit about what's considered rental income, because while that sounds like pretty obvious, there's a little bit more to it, and some things that some things I've learned as we've gone through this, putting this together. We're going to talk about some tax benefits of simply just owning rental properties and what that all entails. We're going to talk about just keeping good records and why that's it's obviously important, but how can we do that and make that easier for you and your accountant down the road? What to expect when you sell your property, some of the benefits and some of the strategies of, different kinds of deferring taxes and things like that. And then, like I said, we'll have some time for some Q&A. So, all right, so let's get to our first topic, which is rental income. I think we all think about rental income as the pretty obvious is the rent that you receive, but there is actually more involved in what is actually considered rental income besides just straight up rent. So Mark, do you want to just talk a little bit more about the other kinds of things that actually are included in rental income?
happy to. What people sometimes lose track of is services, because services add value. So we'll get to that. We'll touch on that a little bit too. But of course, rental income is the rent that's paid. We are all considered, individuals are considered cash basis taxpayers. And simply what that means is you recognize any rent income during the tax year it's received. There's a kind of an exception to that. There's the security deposit. You receive that as cash, but if your lease is explicit that you're going to return that security deposit at the end of the lease term, then you would not include that in rental income. However, if during the course of the lease you apply some of that security deposit to rent or to situations where the tenant hasn't met the terms of the lease, at that point in time, you have to pick up that portion of the security deposit too. If the lease says that we're going to apply the security deposit to the last month's rent, that's considered advance rent. You have to pick it up as income in that year. The same thing with, back to my initial thought on cash basis. If a tenant pays you 6 months in advance and 3 of those months are in a subsequent tax year, you still have to pick up all 6 months. It's considered advance rent. You've received it. It's rental income for the year received.
Okay, so you're only talking about security deposit. That is, let's just say, we never like the security deposit to ever be considered as last month's rent, but I know, there are people out there that do that. But what you're saying, if we receive a security deposit and it is meant to be a security deposit and we receive it and we're holding that in escrow for owners, that is not considered advanced rent.
That is not considered advanced rent as long as the lease basically states you're going to return that at the end of the lease term.
Okay.
So
go ahead.
If a situation would change where the tenant may have violated a provision of the lease and your recourse is to take a portion of the security deposit, at that point in time, that portion does become income.
Okay. So if, because we do get situations like this where we've had in the past people who have paid a whole year up front. That owner then is going to have to pay quite a bit of income tax, or from the rental, because they're going to realize it all in 1 year. And
right, but if they're paying January through December, in January you're going to end up at the same spot. It's when they really they pay it
carry over from year. Okay.
Yeah, and when it spills into say 14 months, then that's going to obviously change some of the picture for that particular tax year. Absolutely.
Okay. So let's talk about an example. This is something I read about today. This was a little bit new, and I don't know how, like we talked about this before. If you're exchanging services, right? Mm-hmm. So this example I read about today, so you have a painter who's your tenant, and they say, I'm going to just paint your property and in exchange for 2 months rent. This said that then the owner would have to claim that they still have to claim the rent as income. Anyway, because you've gotten something else for it. What is that? Is that accurate?
That is accurate. If, say, your tenant is a painter and he paints the inside of your house, the fair market value, that's what's key. The fair market value, that service is then in lieu of rent, is then recognized as rental income. The flip side of it is, since painting and maintenance and things of that nature are deductible rent expenses, the landlord can then deduct that same value as an expense. So when you think about it, you end up at the same spot almost. You end up at zero. But it's an important distinction that just because they're providing service and there's no cash exchange doesn't mean you haven't generated, it's not an income generating act, because they have provided something of value through service.
So what if it's something like an improvement, a home improvement, and is not necessarily a deductible expense, right? We'll talk about that later. The repair and maintenance versus I'm renovating my basement or I'm renovating this kitchen, that's not necessarily deductible. Is that right?
Well, it would be considered improvement, and then you have to depreciate that. But still, there's value being added, and of course, I don't know why someone would, I mean, that would be a lot of rent to exchange to have a whole kitchen put in, I guess. But yeah, it
Correct.
theoretically could
No
happen.
tenant is going to do that.
Yeah,
But
but it could happen. And
I
to
mean,
your point, sure, that's income at that point in time. And then the expenses has to be recognized in accordance with the tax code as far as improvements and how they're treated.
yeah. Okay. And so is there anything else? I mean, these are the point here, I think, for understanding rental income is that there are a lot of other things that could be treated as such. And we definitely do get the we do get prepaid rent, that depending
Sure.
on an application, somebody might say, I'm going to pay 2 or 3 months up front. And that's important to know as a landlord. This is now, you have to do this in the year that you receive it.
And
So,
it's just not improvements. Let's say the lease has provisions where the landlord's responsible for utilities, but in 1 month, maybe the tenant pays the gas bill. Same thing, you treat it like that goes into income because he's paid expenses. The tenant, she has paid expenses on behalf
right.
of the landlord. But again, the landlord can then deduct that expense because obviously, as we all know, utilities are an allowable expense when it comes to leased property.
Okay.
Okay.
Okay. All right. So let's move on a little bit. We all know, that our clients who are on here are, come from a variety of backgrounds. I mean, some people lived in the property and have moved away and expect to return. Other people moved away and plan to never return, and other people bought it as a straight up investment. So everybody kind of has a different approach or a different strategy of what they're going to do with it. But regardless, we all know that there's definitely some benefits of owning rental properties. So
Right.
we're going to touch on all of these as we go through these slides. So obviously, number one, we have tax write-offs. We have depreciation. We're going to talk about all of these. We have pass-through deductions, give capital gains. We'll talk about that, and there's a variety of things there. And then we're avoiding the FICA tax, which is something Mark and I talked about a little, but we wanted to just touch on that. And then, obviously there's some other more sophisticated strategies, such as, but we're not going to even really get into this, but it's, there's a lot of other things you can do, but buying real estate inside an IRA, and what do you do in an LLC? Do you put your properties into an LLC and things like that have other benefits, but that's a little bit beyond the scope of what we're going to talk about. I think we'll probably do some education about things like that later. So, all right, so let's just talk about tax write-offs, because we all want to deduct as much as we can. Nobody, us included. I mean, Craig and I have a couple of properties in our portfolio that our team manages. We have other properties that we own as well. But when we get the call, we had a flooded basement most recently that we just had to, spend a bunch of money. We don't like to do that either. And so we all want to write off stuff. So let's talk about deductions a little bit.
Okay, sure. The general rule I always tell clients right off the bat with deductions is nothing is allowed to be deducted unless the IRS says it can be deducted. So that being said, I always thought Schedule E was one of the better supplemental schedules in a 1040. And Schedule E, of course, is where you report your rental income and rental expenses, because they do a really good job of listing out all these expenses that are pretty much, for the most part, are going to apply to a home or rental property. Your taxes, mortgage interest, cleaning, property management fees, repairs and maintenance, et cetera, et cetera. A couple that they don't list, of course, are homeowners association dues, which are deductible. And another one today, they have auto expense, but a landlord is permitted to deduct the mileage if they want to drive to their property to inspect it. So the mileage they incur driving to the property can be deducted on the Schedule E. So
how does that work with clients like ours who we are their property manager? if they come to visit. Now, I know there's a difference between active and passive landlords and all the hours you have to spend. Are there things if they come to town and visit and want to see their rental property, what, if any,
If,
can,
yeah, if they're coming from out of town and the purpose of the visit is truly to visit the rental property, those are business associated expenses that are the other term I always like to use is you can deduct any expense that's incurred into production of that income. So if their sole purpose is to come to town, to travel to town to see the property or deal with issues on the property, those are deductible expenses on their Schedule E. Now, of course, if there's a dual purpose why they're coming to town, they need to do a good job of keeping records to allocate or to indicate here's the business purpose, here's the pleasure purpose, and treat that accordingly. So
okay, and it comes down to keeping records. So basically,
down to keeping records. It always comes down to keeping records. The
right,
burden
I
of
did
proof
it,
is with the taxpayer.
yes. So things like we stated it for property taxes, property insurance, mortgage interest, property management fees, maintaining and maintenance and repair, and then as you said, HOA expenses, condo dues, things like that,
Right.
okay. And then
And
any
also
other,
just what I do too is you have legal and accounting fees. For my clients who have rental properties, my fees I split. I allocate if they have 3 rental properties, I allocate some to the regular prep, and then I take some of it and allocate it to each of the property also, so they can get some benefit there. Because there really isn't, under the current tax code, you used to be able to put tax prep fees on Schedule A but that's gone by the wayside under current tax law.
so you couldn't, if you have multiple properties, you can't maximize your deductions by putting it all in, just taking it all and putting it in one, is that what
You
you're
have
saying?
multiple properties, you could probably do a pretty good job of getting a bunch of it, but to take 100% of it, consider your taxpayer is probably going to have a Schedule A and a Schedule B, and they're probably going to have a Schedule D, then the 1040, then the state returns. So it would be probably pushing the envelope a bit to put 100% amongst even multiple properties.
Okay. Okay, so let's talk a little bit about repairs versus improvements. We talked about this just now in terms of depreciation. We're talking really about deductions versus longer term depreciation, right?
Mm-hmm.
Okay. Repair and maintenance is simply that something breaks, we got to fix it. You have a roof leak. What about things like a roof replacement? Where does something like that fall? Is it a repair? Is it an improvement?
The general rule is repairs or routine maintenance that restore a property. Improvements add value or extend the life. And using your roof example, if you replace the whole roof, that's an improvement. If you went up and maybe replaced 15, 20 shingles, that's a repair.
Okay.
So
upgrading a whole kitchen,
that's an improvement.
the property, all of those kinds of things that seem obvious are. Is
Whenever
there
you're
anything?
I'm sorry. So whenever you're adding value, that's when you're dealing with improvements, real value.
Okay. Is there anything you can think of that would be, I don't know, sort of, well, I don't know, like that we're not sure whether this is an improvement or a repair. I don't know. I think it's pretty obvious, I guess, if you're, if you do replace something, obviously extends the life of your roof of the.
One of the ones that I struggle with a little bit is new carpeting.
Yeah.
In my opinion, I don't think that's an improvement. I think that's more repair and maintenance, because you're ripping out old carpeting because it's just and if you think of the life cycle of carpeting, it's not 27.5 years.
No. Then that's actually a really good example, because that is something that is, if you continuously have renters and they're pretty hard on it, you've got to continually replace it, and it becomes really a maintenance kind of thing. Okay.
They'd probably change a carpet out every 3 to 5 years, I would guess.
Yeah. Hopefully it would last longer, but
yeah,
I don't know. Some tenants are harder than others,
but if you put down a whole hardwood floor, I could argue that that's not just repair and maintenance. There's a little bit more involved with that, and it's something that adds value that's going to have a longer life.
Okay, we have a question on the roof. So to clarify, replacing a roof is not deductible.
Well, it's going to be depreciated over 27.5 years, the improvement depreciation life, which you have the depreciation up on the screen now. We'll talk about that.
So if we have to, so if you have to replace the entire thing cost you 10, 20 grand, then yes. But if we're if we're just doing a repair because you have a little leak and it's like, okay, this is fine, we replace some shingles, fix it, that's it. Then
We'll
it's
write that off.
okay. All right. Well, that's a nice segue into our next slide, which is about depreciation. And basically, yeah, I mean, I'll let you explain. I mean, I'll like the
Yeah, let's just talk about the house or the building, or what I can call the improvement right out of the bat. A landlord buys an investment property to put on the rental market. What I do is I go to the county's real estate assessment site, and I look at the assessment, i.e., how much of the last assessment was allocated to the land and how much was allocated to the building or / improvement. And using that allocation, I'll take the purchase price, and using the same percentage, that piece goes into land that's not depreciable, and the other piece goes into the building improvement, which is depreciable over 27.5 years. That's the starting point with any rental property. Make the allocation between land and building, depreciable versus non-depreciable, based on real estate assessments that the counties put out.
Right, and you can see that on your tax record for
the
not seeing it. It's
what's really important. I'll make the point here for your audience is, a lot of times I'll get new clients that have rental properties, and the first thing I start looking for is a depreciation schedule, and it's not in there. You all want to keep a record of your depreciation schedule with your tax records year after year after year. One, to have it, and two, in case for whatever reason you go to a new tax preparer, because they're going to need that information to get everything set up. They have to have that starting point. They have to know what's been reported before. So those schedules are real important.
Okay, that's a good point. So if you're a brand new investor, you just purchased property, or you just became a landlord, and you start this, where do you get that? Where do you start with that? Or you just start with your first tax preparer and you say, okay, this is my rental property, and this is
first place, you hand your tax preparer the settlement sheet, and he'll go from there.
Okay.
He or she will go from there, and the settlement sheet has the purchase price. And most jurisdictions are really good now with all this information online as far as the assessments and whatnot. So that's it's all right there. So that's how you get started.
Okay, so you're going to depreciate the improvement, the actual building. And then, as we just talked about, any other expenses that become improvements, right?
Right.
Okay, and then that is just factored out over 27.5 years. Now, when you sell the property,
let's step just 1 second before we go there. I'm sorry.
Yeah,
I just want everybody to understand appliances. If you buy new appliances for the building, that's 5-year depreciation. Okay. If you put a new fence or shrubs in, that's 15 years. So there are some differing lives, but it's pretty much going to be 27.5 years for the building and improvements, and 5 years for furniture, kitchen appliances, things of that nature.
Okay.
Okay.
Okay, that makes sense. Yeah, and so all this time you've owned this property, your property is depreciated. Okay, so you own it 20 years. Now you're going to sell it. And so talk about how that is treated then, in how it's recaptured, and how is that taxed then when you go to sell a property?
Well, most people, you sell on a capital asset, of course, all right, I get capital gains treatment, which capital gains rates are obviously or generally much better than ordinary rates. However, the one piece that does not get capital gains treatment is the depreciation that's been taken on the property over the years. The term it's used is it's recaptured, and that piece of the gain will be taxed at ordinary rates, not at capital gains rates.
Okay, so let's give an example. I mean, well, if it's simple? Is there an example that is,
Well, let's say you sell a property for 100,000 and you have $50,000 of basis. You have a gain of 50. The depreciation on it was 10. This is really simplistic. It's not this simplistic, trust me. 40,000 will get capital gains rate treatment and 10 will get ordinary treatment.
okay,
And me personally, I have like what I call a shell spreadsheet where I do all these calculations in a spreadsheet and then I compare to the tax return because, like I say, it gets a little bit, there's a little bit of complication to it. You want to make sure you get all the pieces on the right forms and they're reported correctly. So that's why I like to do it first and make sure I come up with the answer that I expect and then compare it to the program and see, okay, did I get the right answer? And so that's how I do it. But yeah, it's a little more complicated what we just said, but that's the basic premise behind it.
all of tax accounting is complicated. Okay. All right, so let's talk about some pass-through deductions. So basically, okay, you can talk about this, but basically, because we talked about this a little bit, this may not apply to everyone, but essentially if it applies, I guess this deduction allows you to take up to 20% of your qualified business income on your personal taxes. But how does this? Who is eligible for this and who is not?
Well, this is called qualified business income, and it came about with the 2017 Tax Act. What among many things that Tax Act did, it reduced the corporate tax rate down to a flat 21%. So to try to make all the folks who have pass-through entities whole, because most pass-through entities are going to pay tax at the individual rate, which can get up to 35%. They put in this provision that allows you to take 20% of any of your eligible business pass-through income and deduct it right off of your income to arrive at your adjusted gross income. A late addition to it was rental properties, and the rental property has to be treated as a business, and there's certain criteria that has to be met in order for the taxpayer to take this position. And one of them is called a safe harbor election, where you have to essentially sign a piece of paper that goes along with your return that say you meet all this criteria. This really is a little bit too far above the scope of what we're trying to accomplish here, because everybody's situation is unique and different. And my best advice here is to discuss this with your tax preparer to see if it would qualify. One other note on this whole tax law is scheduled to sunset on December 31st, 2025. And so all this will go away, or this particular provision will go away amongst many others, unless Congress acts before then, which we're planning on it sunsetting. Let's put it that way.
So what was I just going to say? So who meets this criteria? So this doesn't really have anything to do with if your property is in an LLC or it's treated as like this is nothing to do with it, right?
It's really the facts and circumstances around the property and what's going on is really what it's all about. I mean, there's hour limitations. You have to spend X number of hours dealing with the property and issues, and there's a few other criteria, and so yeah, it's just not as simple as saying, okay, I set up an LLC, therefore I qualify.
I'm now a business, and then therefore you can.
Yeah.
Okay, so the point of this whole thing is to kind of bring this up to be able to say, this is something you should at least be aware of, that this exists, and you can find out whether it's, whoever works with you to do your taxes, to just know whether you actually could qualify for it. Because if you can, there is some good benefit, at least till 25.
It's been a wonderful benefit, to the point where a lot of preparers for 2025 are going to be forcing a lot of income into 2025 for pass-through entities.
So you really think it's going to go? It's really just a political thing, right? Whether it's going to go away or.
Well, there's so much in the tax code that it's really going to be hard. I just don't see it lasting because I think they're going to push. Well, the expectation is the 21% corporate rate will go away also. So then the corporate rate's going to revert back to pre-2017 tax law.
Okay, great.
Well, then what happens then? Oh, the SALT limitation for state and real estate and state and local taxes goes away. That limit drops. And this doesn't apply to rental folks, but the $1 million mortgage comes back online. The $100,000 HELOC borrowing comes back online. So there's a lot of stuff. There's a lot of moving parts that potentially that it all comes back if they don't do something.
Well, that's going to be something to watch, I guess.
Yeah.
Okay, so this is an important point, something to check on. All right, let's switch gears a little bit and talk about, I mean, not switch, let's talk about capital gains, because so we have short-term gains, right? So there's a difference here in the short-term, long-term. If you've held a property, you own a property, you've sold it within a year of owning it,
Right.
then you're taxed at an ordinary income rate.
At the ordinary tax rates, correct.
Right. And then after a year, then you're taxed significantly less.
You get the long-term gain treatment, except for that piece of depreciation that's recaptured.
Okay, correct. And then obviously, I don't know how many people are familiar with, there are ways to defer capital gains taxes, and that is through doing a tax deferred exchange or a 1031 exchange. This is actually a series I wanted, or a webinar I want to do with one of the intermediaries I've worked with probably for 20 years, because there are some really good, we actually did one with, actually I see her on there. We did with one of our clients. I've done this with a number of clients over the years, and it's a good strategy in a lot of ways. If you paid off your home and you have no more deduction, you can, there's a lot of rules around it. There's a lot of benefits. There's the right time to do it. That there's so much more we could talk about it, but, and we will, because I think this is a good topic, because this was something I learned recently about the exchanges too. I mean, even after you can pull money out of it and still defer the rest. I mean, then there's a lot of things you can do that could be beneficial for people based on their strategy, their needs, how long they've owned a property, and so on. So there are ways to defer that. I mean, you can continue to defer that tax and forever, I mean, so what you need to know about capital gains taxes and deferring taxes is that there has to be an intermediary that works with you in this process. They essentially take the money from the sale and then hold it, and then make sure that it's then used for the other purchase or purchases in the right time frame. So they make sure you comply with all the laws. Is there anything else, Mark, about capital gains that's important or relevant
Well, I think to just on the 1031, and I think you did a good job of emphasizing it. Planning is really key to execute a successful 1031. It takes a little bit of planning, a little foresight, and as you said, you got to get an intermediary to help you construct the deal. The second thing on long-term gains or any short-term gains, well, this mostly would apply to long-term gains. If you have suspended losses over the years on your rental properties, in other words, your income's too high, you have losses year after year, those losses become what's suspended because you can't deduct them in the current year. At the time you sell, all those losses are released and you get benefit of them at the date of sale. So you don't lose them. They simply become deferred or suspended is the term we like to use, and you get to use them at the date of sale. So I think that's important to
okay, we have one question this is a good question. So if you do a 1031 exchange, do you still have to pay taxes on the previous depreciation at that time?
Generally not. No, not the ones I've seen. because you're just rolling everything up, and you basically, the depreciation starts with the old property.
With the old property, yeah.
Yeah.
Okay. All right. Okay, so let's talk a little bit about this FICA tax, and what does rental property have to do with being able to not pay this FICA tax?
Well, the beauty of it is income from rentals is not subject to payroll taxes, i.e. FICA or Medicare. So it's not earned income. And then on the flip side, I guess you can't make tax deferred retirement contributions on the income, but it's income that's not subject to payroll taxes. So there's a nice savings there. Could be, 15%.
Right. Okay. All right. That's just important to know. I think this is, one of the things we try to do for our clients, and as everyone who's on here is a client knows, we just changed over to a new software, which is going to have some really good features in terms of being able to separate out properties and do other kinds of reporting that we weren't able to do, more customized reporting in our old software. We're still learning a lot of this, and we're going to take full advantage of the capabilities it has. But I think that, for us, for our clients, we are the ones that are keeping these accurate records. We have income, expenses, we have all of everything that we can show for them from that aspect, that they can then take to their tax preparer. Also, what was I just going to say? That yes, for those who have multiple properties, separating that out, we can also do that, because I know that's an important piece of it. Obviously, the better you keep your your records, the smoother it's going to be, and it helps you really keep track of what, how each property is performing. That's also another thing that is one of our goals, is being able to provide people with some snapshot portfolio performance metrics. We're going to start implementing some of that this year. It's a little that's not really necessarily to accounting, but it's something that's really important, because again, no matter how you arrived at owning this rental property, we want it to perform its best, and we want to be able to show how it's performing on a number of levels. So keeping all receipts, which for us, again, all our invoices, all of those things are all documented and attached for every client. But outside of that, any investor, any landlord should be keeping all that, credit card statements. Obviously, none of us want to get audited, but we want to keep all that for those reasons. As you said before, travel expenses, gifts, anything else around that, keeping all of those makes it just so much easier later.
Just as a note on record keeping, the statute of limitations for a tax return is 3 years from the date it is filed. It stays open for 3 years from the date it's filed. So you definitely want to keep all your records for that 3-year period while the statute is open.
Okay.
The only way that the service could open it up longer is if there's a suspicion of fraud. Then they can keep it open for 7 years.
Okay.
So,
okay,
3 years is the rule of thumb. And what I always tell clients, if you don't want to keep all the contemporaries paper around after that time frame, never, ever throw away your tax return. Always keep a hard copy of the tax return.
Yeah, like your title insurance. Don't ever throw that away.
Yeah.
Okay, so we actually talked about a couple of these things as we've gone on, but when you sell your property, the suspended losses, can you just explain that a little bit more? So you're saying, just explain a little bit more about how this actually works.
Well, a taxpayer can deduct up to $25,000 of rental losses, up to $100,000 of a modified adjusted gross income. Once modified adjusted gross income exceeds $100,000, the loss becomes limited to the point where once their modified adjusted gross income reaches 150, they get zero of that loss in the current tax year. What happens is then, if that continues on year after year, all those losses accumulate. And this is another thing about changing returns. If I see rental property, I always look at I'm looking for carryover data that tells me what the carryover suspended losses were from the prior year, because I got to get that in the current year return so we keep moving forward with it. So as those losses accumulate, you don't lose them, even though you can't take advantage of them in the year they're incurred. However, you get them on either A, your income starts to drop and you start to fall under the threshold and those losses will start to be released, or B, when you sell the property, and at that point in time, they're all released and they're essentially added to the basis of the property. So it reduces your, you get advantage of it, take advantage of it at that point in time.
Okay. Okay. And then, so we talked already about capital gains and deferring it. Now, there always is a question at closing. Have you lived in this property 2 out of the last 5 years, right?
Mm-hmm.
As an investor, if you buy it as an investment property, that's not really going to apply. But if you owned this property and you have moved out and you lived there for, let's say you lived there for 10 years, right? Now you've moved out and you're going to come back, in 2 years or 3 years. And so you can answer the question and you decide to sell it. You can answer that question. Yes, I have lived there 2 out of the last 5 years. How does that work? What does that mean? What does that mean in terms of
what I've seen before in the past, the more common scenario, I have a house or a taxpayer's a townhouse. Okay. They're going to upgrade to a single family home, and rather than sell the townhouse, they're going to put it on the rental market. So the first thing I tell them, I said, you got to understand this 2 to 5 years rule, because once you get outside of that, you lose the exclusion. However, if you sell that property 5 years after moving out of it, or I should say would be, gotta do my math here. If you sell it and you're still within within 2, I guess it would be 2 to 3 years after you move out, because you're in the 5-year window, there could be a limitation on the exclusion, because you've created a business property. You have a personal property and a business property, and it's possible there could that exclusion that's available to you could be limited somewhat. Could be some limitations on it because you did convert it to a business property. But you're not going to lose it all. You might lose some of it.
Okay. I mean,
a lot of it's going to depend on the situation, and it all comes in play when you start putting the numbers together, the sales price and whatnot. And that's assuming you have a big gain on it.
Right. But okay, so that gain, that exclusion, it's what, 250
for single, 500 for married, filing joint.
Right.
And of course, you can only take, I think you can only take advantage of that. It's either every 3, every 4, every 5 years. I'd have to look it up. I'm sorry, I don't know it off the top of my head, but I'd have to look up how often you can do that.
You owned it as a primary residence, then you rent it out. Okay, so then you do that same thing again. Right. You're just saying that, okay.
Yeah.
So question is there a special provision for the 2 5-year rule for people who have lived abroad on government orders? I heard it suspends in that instance.
I believe there is, but I would have to get back to you on that one. I'd have to look that one up. Okay, anytime you go overseas on government orders, all the rules change.
Yeah, no, that's a good point, because a lot of our clients are government that's actually a very good question, and something very applicable to this audience. So that, that's I'm going to find that out and include that in.
I'm happy to get back to you on that one. I don't want to just go off the top of my head on that one, because I'm pretty sure there is
everything, Mark. You don't know every law that's out there.
Yeah.
I don't even makes my head spin, but it's important. But no, thanks for asking that question, because
absolutely
we will come back and get that answer. Okay. So I think, we didn't want to get too deep because we could go into, I don't know, down a lot of rabbit holes in um, tax law, tax strategy, other things. Like I said, there are a lot more sophisticated strategies. Some of those I'm going to explore in more depth than we should have said this in the beginning. I'm going to say it now. I certainly am not a tax expert. Mark is a tax expert, but he is also not your tax expert. So that everyone's situation is unique and important that you seek someone who can help you. Mark, if you can certainly help any of you, if you engage him to help. Um, he's a great CPA and he's helped us quite a bit, but I think it's important to understand your own unique situation. So that disclaimer is out there that we are not giving tax advice. We are just giving the information we know that a lot of the questions that we get from our clients, we wanted to be able to answer in an organized way and be able to share some of this with you. But clearly there are a lot of benefits of owning rental property that are related to saving money in taxes and helping provide a good income from your property. But so I know everybody's muted. We'll open it up to questions. If you have questions, you can put them in the chat. You should be able to unmute yourself and ask the question, or I can unmute you if you have other questions. If there aren't questions, then we can, you can, and if you don't think of it now, or if there is a tax related question, you're welcome to email me, or better yet, you can email Mark. You can email me and I'll share it, but this is Mark's email and he is busy in tax season right now. So, I'm happy to field those questions, but it's it's simple, but it's complicated. And there's things like you said, always changing, and we want to be able to stay on top of whatever comes along, laws that change and things that we can then share with you and hopefully at least create awareness and help you maximize whatever deductions and maximize the benefits of owning rental property. So, I don't see any other questions, but anything else, Mark? I mean, before we kind of close out, if we don't have any other questions, anything else that?
I think too, everybody, and again, this is probably, it could probably be another webinar soon at some point. I think everybody has to consider how they title their property, whether it's best to keep it outside a trust. It may be best to put inside of a trust. And a lot of that all depends. And I think those are considerations everybody has to think about. It's just not the next couple years. It's a little bit more long-term planning. And there are professionals out there who can help you with those decisions. And I just believe it's things you want to think about.
Yeah, no, that's actually a good one. And for those of you that don't know, I have a YouTube channel that is called Richey Property Management. And a lot of those videos are around things that we see that come up that's really for landlord education. I did an interview with one of our trust attorneys. And we talked a little bit about because that question comes up a lot. Should I put my property in LLC if I only have one property, and this and that? And that's again, there's a lot around it and the trust and how do you set that up. So that's definitely been on my list of things I think could be a good topic. Anyway, I thank all of you who have taken the time to attend. I hope you got a little bit of some nugget out of this. And again, if there are questions, feel free to email me. I'm happy to convey the information. I'll try to get you answers to whatever I can. And yeah, and thank you, Mark. I appreciate your knowledge. I know this is again, super busy time for you. So
I appreciate you giving me the opportunity, and you're quite welcome.
So I hope that video was helpful and that you got a couple of nuggets of information maybe you didn't know about your taxes and rental properties. There's definitely some advantages. So if you live in the Northern Virginia area and you need a good CPA, someone who really knows how to work with landlords, definitely give Mark a call. I'll put all his information in the notes below. And if you like this video, please share it with someone else who could benefit from some of this information. Don't forget to like and subscribe, and I'll see you next time.